This dial represents the Economic Fragility Index, and for the fourth consecutive month, it is locked at a 52.8% amber alert. The catalyst for this persistent stress is the Federal Reserve. By holding the benchmark rate steady and publicly acknowledging that inflation is running hotter than projected, they have signaled that relief is not coming. Markets reacted immediately. The S&P 500 dropped over 1.3%, and the VIX Volatility Index, a key measure of market fear, spiked intraday as investors digested the reality of a higher-for-longer rate path. When you combine deeply restrictive interest rates with widespread commercial real estate distress and extreme market valuations, the math points heavily toward one of two outcomes: a prolonged stagflation trap or a sudden credit cascade. This spelt dashboard tracks the structural drivers of that fragility. In the red column, the federal funds rate is stuck at 3.625%. U.S. office vacancy hits a critical 18.2%. And the CAPE valuation ratio is near 38, bordering historic extremes. In the amber column, high-yield credit spreads are widening to 3.28%, while Brent crude oil spikes above $100 a barrel. That energy spike is directly tied to recent geopolitical disruptions, specifically targeted military strikes on major Middle Eastern gas and oil infrastructure. Together, these extreme readings officially activate what we call the banking solvency constraint. Under these conditions, any corporate strategy that relies on high leverage or commercial real estate expansion is mathematically unviable. To figure out exactly where this leads over the next 6 to 18 months, we ran this data through 5 independent predictive models. This chart shows the probability distribution. The longest bars are the base cases: a valuation correction at 35 to 55% probability, and a prolonged stagflation trap at 35 to 45%. Notice the bottom bar. A quick diplomatic de-escalation that lowers oil prices is the least likely outcome, sitting at just a 15 to 25% probability. This exposes the Federal Reserve's trap. Because core inflation remains persistently elevated, the Fed cannot intervene with rate cuts to catch falling equity markets. The structural safety net is completely gone. The true danger is in how long this data has stayed elevated. The Avalanche Index, a complexity model that looks for structural breaking points, shows that a 4-month streak of a steady 52.8% amber alert is an illusion. This dual-axis chart visualizes the paradox. The top line shows the fragility index perfectly flat, but the rising shaded area underneath shows what's actually happening, a dangerous loading condition. The system is quietly absorbing market shocks and building hidden pressure. That pressure, rapid credit spread contagion cascade, where corporate borrowing costs would spike violently. This risk isn't obvious in standard metrics, because blind, mechanical, passive investment flows are currently buying up debt regardless of the underlying risk. This artificially suppresses those credit spreads and hides the true danger. When an external shock eventually overwhelms that passive buying pressure, the artificial stability will break, triggering an immediate and severe repricing of global credit. Global planners need to immediately stress test their operations against a prolonged high-rate environment and a sudden 20% drop in equities. For operators in Australia and New Zealand, the timeline is even shorter. Because your residential mortgage markets are structurally dominated by variable-rate loans, any global credit stress will transmit to your domestic economy 3 times faster. The market consensus expects a continuation of stability. The underlying math guarantees extreme fragility. Planners must ignore the consensus and act on the math.